This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Nowhere to hide. An intense late-day sell-off sends the three major indexes into the correction zone, down 10% or more from their recent highs. Not a single market sector is up for the year so far. So where can you find cover?
Switching cities, the Rams move west, General Electric goes north. The big money behind two stunning relocations.
In it to win it, the record jackpot grips the nation. But why do we play, even when we know we won't win? All that and more tonight on Nightly Business Report for Wednesday, January 13th.
Good evening, everyone, and welcome. The selling was intense. The financial pain that has dominated the market so far in 2016 was back again today. The slide steepened late this afternoon, despite earlier gains that the market just really couldn't hold on to. All three major indices falling 2% or more, now in correction territory. The Dow Jones Industrial Average plunged 364 points to 16,151. The Nasdaq dropped 159, nearly 3.5%, and the S&P 500 lost 48, trading below 1,900 for the first time since September. And the selling occurred despite a modest rise in the price of domestic crude, very modest. For the year, the blue chip index is off about 7%, the Nasdaq down more than 9%, and the S&P 500 is also off 7%. Bob Pisani explains why this market just can't seem to catch a break.
It was another day where traders just wanted to take down their exposure to the overall market. Everything was down 2 to 3%, from auto stocks to financials to healthcare to technology stocks, virtually everything. There's a distressingly similar pattern in the trading activity in the last few days. Stocks invariably start to the upside, but then traders sell directly into the rallies. It doesn't help that oil has been very volatile recently, but this sell into rally things is relatively new. Traders seem to be in no mood to pick up any bargains at all. Oil is a symptom, though, of a larger issue going on. There's concern that global business activity is slowing down. You can see this in the earnings reports. Recently, we've had 23 companies report fourth quarter earnings, including big consumer names like Nike and Bed Bath & Beyond and General Mills. 19 of the 23 have missed revenue expectations. That's a sign that business conditions are slowing down. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The Federal Reserve says the economy expanded at a modest pace across most of the country in December. The central bank's Beige Book survey of economic conditions showed an increase in consumer spending and a tightening labor market. Growth reported in 10 of the Fed's 12 regional districts. Federal Reserve policymakers next meet in about 2 weeks.
Ahead of that Fed meeting, Boston Fed President Eric Rosengren said estimates for economic growth are falling, and he's urging caution on further rate hikes. Speaking to the Greater Boston Chamber of Commerce, he said that despite significant progress made over the past year, current events have to be taken into account.
It's really important that despite some of the weakness that we've been seeing over the last week or two, monetary policy shouldn't overreact to the short-term fluctuations in financial markets. That being said, we have to be aware that there are downside risks to our forecast, and we have to take quite seriously what's happening elsewhere in the world.
Mr. Rosengren added that the future path of rate hikes will be highly dependent on the Fed's evolving outlook.
Well, as stocks sell off, some of the nation's biggest banks are getting ready to report their earnings tomorrow. J.P. Morgan, Friday, we hear from Citi. And Morgan Stanley and Bank of America are due out early next week. But as Kayla Tausche reports, there may not be much to like in those quarterly results.
Banks were supposed to be one of the bright spots in the market, but they're going to need to get through what looks to be a dismal fourth quarter of earnings before they turn around. Analysts are expecting ever so slight revenue growth of around 2%, but a sharper rise in profits thanks to massive cost cutting that is still ongoing. The street actually sees Bank of America improving the most over last year, but sees Wells Fargo's business model as being able to best stand up to recent headwinds. Some of those headwinds are too big to ignore. First, the steep decline in oil prices. Banks collectively have more than $100 billion of debt related to the energy sector. Now, most of it is high grade, but they're having to set aside more money in case of potential losses. Second, Higher interest rates will mean the banks earn slightly more money on some loans they're underwriting, but there's a worry that credit quality has peaked. The number of companies and consumers defaulting on their debts is at or near an all-time low. Experts say it can only go up from here, and that's a problem as debt is getting more expensive. In the past, volatile markets like energy and interest rates would have spurred more trading activity, but executives like JP Morgan CFO Marianne Lake have said a seasonal slump in trading activity that has plagued recent years will also be present in the fourth quarter. We will hear from JP Morgan, the first out of the gate for the major Wall Street banks. For Nightly Business Report, I'm Kayla Tausche in New York.
A bright spot today was General Motors. The automaker raised its earnings guidance for 2016 while also dramatically increasing its stock buyback program and its quarterly dividend. The upbeat outlook follows what many think will be one of the most profitable years ever in North America for GM.
Our overall financial outlook for 2016 is based on a strong product launch cadence, growth in adjacent businesses, modest global industry growth, and aggressive efforts to drive efficiencies.
The improved outlook comes 2 years after Mary Barra took over as CEO. Shares of General Motors rose today in the overall down market.
Well, from one general to another, General Electric, a longtime resident of Fairfield, Connecticut, and one of the nation's largest businesses, of course, will move its headquarters to Boston and the city's fast-growing South Boston waterfront. State and local government officials offered the conglomerate $145 million in incentives to make the move, which will likely have little effect on the majority of its global workforce. Following the announcement, Connecticut's governor expressed his frustration.
Of course, I'm disappointed. I know many in Connecticut share the disappointment and frustration. Today's decision is a clear signal that Connecticut must continue to adapt to changing business climate, actually a subject that the president touched on extensively in his speech last night. So I say continue because Connecticut is already in the process of changing dramatically.
According to CNBC's Top States for Business study, Massachusetts ranked 20th overall. Connecticut finished 33rd last year.
Shares of MetLife also bucked the broader market trend and finished higher. This on news we reported to you last night that insurance company is looking to sell its U.S. retail business, and that is leading many to wonder whether others will follow suit. Recall that activist investor Carl Icahn is pushing AIG to break up, in large part because of the government's plans to oversee the insurance industry's big three. Mary Thompson tells us whether getting smaller will become a big trend in the insurance industry.
Already fighting the government in court, MetLife is seeking other ways to remove its businesses from the Federal Reserve's oversight.
At the end of the day, I think it's a good move for MetLife.
Like property and casualty giant AIG and rival Prudential, regulators tapped MetLife as a non-bank systemically important financial institution. This because of its size and complexity. The increased oversight, a key reason it's now planning on selling or spinning off its domestic variable annuity business.
By separating that business, it reduces the potential for increased capital requirements on it.
MetLife doesn't expect the sale to change regulators' minds about its remaining businesses being systemically important, though the news did send MetLife stock higher. In the wake of the financial crisis, regulators increasing oversight of large non-bank firms that are seen as posing a threat to the U.S. economy in the event of another crisis. The additional capital and reporting requirements expected to be costly for these big firms. It's one reason activist investor Carl Icahn wants AIG broken up. He believes a smaller firm might be removed from Fed oversight, eliminating those costs and potentially unlocking value at the insurer. It's a move analyst Jay Gelb sees AIG continuing to resist.
My sense is that AIG is highly unlikely to split the businesses for a variety of reasons. But now with MetLife saying they will undertake a split, that puts pressure on AIG to justify why they would keep the company together.
It might also put similar pressure on big banks. They've resisted breaking apart despite the additional regulatory burdens imposed on them after the financial crisis. But with shareholders reacting positively to MetLife's decision, it might prompt some big banks to rethink theirs. For Nightly Business Report, I'm Mary Thompson.
Still ahead, low risk, low cost, high reward. Maybe why the entire nation is playing the Powerball lottery, even though the odds are stacked against you. First, so we'll look at how all 30 Dow components closed today. All but one finished lower. ExxonMobil.
Securities regulators are reportedly looking into the risks posed by high-yield bond funds in the aftermath of the collapse of Third Avenue's junk bond fund last month. As reported by Reuters, regulators are concerned about how mutual funds manage their liquidity risks. They also want to determine the impact such disruptions could have, not only on shareholders, but also on the broader market.
The workplace is changing, the rules are evolving, and some of the proposed changes, especially to paid sick leave, are making small business owners stand up and pay attention. Kate Rogers reports tonight on a growing concern for some on Main Street.
In President Obama's final State of the Union address, worker protections were front and center.
Equal pay for equal work, paid leave, raising the minimum wage. All these things still matter to hardworking families. They're still the right thing to do. And I won't let up until they get done.
The comments come at a time when the push to build up employee benefits at businesses nationwide is gaining momentum. But new data analyzing one congressional paid sick leave bill shows Main Street could be hard hit. The conservative National Federation of Independent Business modeled the Healthy Families Act, which allows workers in businesses that have at least 15 employees earn up to 7 paid sick days per year. If implemented this year, the NFIB says the mandate could result in the loss of 430,000 jobs over the next decade, 58% of which would be at small firms. What's more, the NFIB projects a real output loss of $652 billion, half of which would be borne by small companies like Larry Stottlemyre's Adventure Park USA in Frederick, Maryland. Stottlemyre has up to 130 employees in the summer and 45 in the winter, but only 6 have paid sick days. Extending the benefit further would be a burden for the business, as he hasn't yet fully recovered from the last recession.
And to come up with this stuff when we're just coming out of a recession, we just got hit with a minimum wage increase in the state of Maryland. Our last governor hit it with that. And that's something that we're absorbing now, and then every time we turn around, there's something else, and it's really unfair to small business people, entrepreneurs that have risked their homes, their livelihood, and has put everything into their businesses.
But advocates say change is necessary and momentum is building in 2016. In the past year, big companies, including Netflix and Microsoft, announced enhanced paid leave plans.
We live in a nation that says we care about family values, and yet being a good parent to your child or a good child to your parents literally cost people their paycheck and often their jobs.
While getting a bill passed in a Republican-controlled Congress may prove tricky, on the Democratic side, there's growing support for better policies nationwide. In the past week, both Hillary Clinton and Bernie Sanders have expressed support for full paid family leave policies. For Nightly Business Report, I'm Kate Rogers.
To read more about the push for paid sick leave, head to our website, nbr.com.
A brewer launches the second largest corporate bond deal ever, and that's where we begin tonight's Market Focus. Anheuser-Busch InBev is selling $46 billion worth of bonds to help finance its $110 billion purchase of rival SAB Miller. The deal is second only to Verizon's $49 billion offer in 2013. Investor demand, however, was the most ever for a corporate bond deal, with the maker of Budweiser beer receiving more than $100 billion in offers. Shares of Bud were off about 2.5% to $116.14. Shares of SuperValu got slammed today after the supermarket chain disappointed with its latest quarterly results. The company's revenue fell more than expected in the face of stronger competition. Last week, the company said it would spin off its discount brand Save-A-Lot, which accounted for more than a quarter of SuperValu's sales in the quarter. Shares were off 15.5% to $5.08. And auto parts maker BorgWarner issued full-year earnings guidance below Wall Street forecasts, the company citing in part a strong dollar for coming in light of targets. Borg sees double-digit sales growth for the year, but that still wasn't enough to please investors. Shares were off more than 9% to $33.84.
Shares of Intuitive Surgical managed to eke out a gain on an otherwise bad market day. The company gave fourth quarter sales projections that were ahead of expectations. Main driver, continued growth in the robotic system used for minimally invasive surgery. Intuitive Surgical closed the day up a little bit there, about 0.5% at 545.14. Qualcomm getting an upgrade from Susquehanna Financial from neutral to positive. The analyst there saying that while the semiconductor company still faces competition from the likes of Intel, he believes the worst may be behind Qualcomm and its stock. Shares were off about 1% today to 46.10, but they've fallen nearly 40% over the past year. GoPro says its revenue for the fourth quarter are going to come in below expectations, slower sales of its action cameras. The company also cutting 7% of its workforce. Shares of GoPro flat today, but this news did break after hours and the stock was halted. When it reopened, shares dropped more than 20%.
$1.5 billion. That's the record jackpot in tonight's Powerball drawing. People are standing in long lines for the chance to win the pot, even though the odds are slim, extremely slim. Eric Chemi catches the Powerball fever that's gripping the nation.
With just a few hours left to buy tickets in tonight's record-setting Powerball lottery, people all over the country are lining up and spending big bucks to get a chance at the $1.5 billion jackpot.
Oh, I'm going to win. This is the winner.
It's the biggest jackpot in American history. Still, the odds of winning this week are no different than they were last week, 1 in 292 million. But the excitement isn't about the odds, it's about the big prize.
What would you do with the money if you won the big prize?
I would vanish.
I would take my whole family and disappear somewhere.
I'll give a lot of it to people I love and care about.
Take care of the family.
Everyone's got their own strategy for picking numbers, whether it's letting the computer pick for you or choosing lucky numbers like your birthday. Some are doing exactly the opposite, going for unlucky numbers, hoping to avoid sharing the big prize.
I found that, that's most people have lucky numbers, so I'm trying to go against that so I'd win the whole thing for myself, huh?
No matter who wins tonight, these local grocery stores come out on top. They get to keep 5% of every sale.
Today was top sell was 800.
Tickets or dollars?
The dollars.
I know the odds of winning are long, but in order to properly tell this story, I feel like I need to take a chance as well. One Powerball ticket, please? Thank you. For Nightly Business Report, I'm Eric Chemi in New York City.
Thank you.
Thank you.
If he wins, we're going to split it. He's got to turn it back in here. All right, so why do people get lottery fever when the jackpot swells to a staggering amount of money? In this case, a whopping $1.5 billion. David Just is a behavioral economist at Cornell University's Charles H. Dyson School of Applied Economics and Management. He's here to answer that, among other questions. My odds, Professor Dyson, are 1 in 292 million, the same basically every week because it's 60-some numbers times 6 places or whatever it is. But why is it, tell me from a behavioral point of view, why I will get out of my chair to go try for $1.5 billion when I couldn't be bothered for 40 million?
It's a good question. Basically, there are two things going on. First, we know that essentially when people evaluate these sorts of gambles, they focus in on the large numbers. If you have a giant possible, jackpot out of this, people completely ignore the probability of winning and just become enamored with the idea of winning that much money. But it's not only that, we also have this sort of feeling of we're going to regret it if we don't at least try.
Yeah, there's a fear element, isn't there? I mean, what if you've played lucky numbers in the past? you decide you don't want to do it this time around and those numbers come up, you'd be devastated, right?
It's absolutely that. It's, you know, when we see the winners, when we see other people who've you know, actually made it big, we feel like we should have been doing something, and we had a chance, and we could have done it, and all we had to do was buy the ticket. So it's sort of predicting that regret. We decide it's time to buy.
Our producer, Rebecca White, was saying today she was in line to buy. She bought one ticket. She thought, well, the guy behind me might have the right number, so I better buy another ticket or he's going to get the number that wins, not me. So it plays with your mind a lot. Let's go to the question of happiness. People who win, you say the history is not all that good. They do not report higher happiness.
No, they don't. So people have this anticipation that you win this much money and just all of your cares sort of melt away. And you have that as an expectation, and then you actually win money, and reality sets in that, no, you still have a whole bunch of problems. And you know, while it's a huge, huge amount of money, it's still not unlimited, and it still doesn't quite buy you all the sorts of things you want in terms of, you know, well, a lifestyle. So no, on average, they're actually less happy than the average person, and even less happy than people who've been put on kidney dialysis, believe it or not.
Whoa. That took me by surprise. You know, there was one gentleman who was interviewed who was a previous lottery winner I saw on one of the other networks, and he said he actually felt sadness and guilt because so many people came to him and with very tough luck stories. So he felt terrible if he didn't give them some money. It was a real burden to him.
There's exactly that. A lot of people will come out of the woodwork and you feel like, you know, you've been so lucky, you need to help others who haven't been lucky. And just managing that amount of money, you know, if you work for it and you build it up over time, you adapt to it over time. Mm-hmm. But otherwise, it ends up being something that you can't fathom. And so they end up having higher rates of bankruptcy, believe it or not.
Here's the $1.5 billion question. Have you bought a ticket?
I have not.
Do you ever?
I've never played the lottery. I studied it a lot. I guess you could say I'm still studying my first purchase.
Spoken like a professor. David Just of Cornell, thank you very much.
Thank you.
All right, coming up, the NFL scored big, so did the city of Los Angeles, which is about to see a big spike in revenue to that area. That story's coming up next, but first a look at how the 10 sectors in the S&P 500 fared today. And as you can see, it was ugly out there.
Here's a look at what to watch tomorrow. As we reported, J.P. Morgan Chase due to come out with its earnings along with the Dow component Intel. Best Buy will release its holiday sales figures. St. Louis Fed President James Bullard speaks on the economy and monetary policy in Memphis, and that is what to watch Thursday.
The Rams are moving west to their new home in Los Angeles, and the San Diego Chargers have the option to join them. The announcement late last night came after a day of marathon meetings. Jane Wells tells us why the decision is as much about business as it is about the sport.
Well, it stays to the last minute.
It was a long night for Tom Benson of the New Orleans Saints and other NFL owners. And finally, just as the State of the Union was about to begin, the state of American football changed.
The NFL owners tonight approved the return of the Los Angeles Rams to the market, starting with the 2016 season.
Stan Kroenke's St. Louis Rams beat out a tag team of the San Diego Chargers and Oakland Raiders because he's promising a glitzier stadium in the LA city of Inglewood, unlike anything the NFL has ever seen, and outshining a proposed stadium in Carson by the other two teams. Now the Chargers have 1 year to decide whether to join the Rams in Inglewood, and if they decline, the Raiders get that choice. The league is also giving both losing teams $100 million towards new stadiums should San Diego and Oakland choose to build.
We'll be working really hard to find us a home, and that's what we're looking for. And so for our fans and everything else, don't feel bad. We'll get it right.
But after a 21-year NFL drought, does Los Angeles have a fan base for one or possibly two teams? From a business perspective, it may not matter.
Ultimately, it may not matter if the NFL Ultimate's end game is to just have a showcase facility in the second largest market in America, where they can have Super Bowls every 5 years.
And with the Clippers and Dodgers selling for $2 billion each, any LA NFL team would be worth at least $3 billion. Wealth spread to all the owners. Some fans were not the only ones feeling low. Bob Iger had spearheaded the losing stadium proposal in Carson and hoped to be part of that enterprise after retiring from Disney. What was harder, buying Pixar, Lucasfilm, or this?
I'll let you know when this is over.
In the meantime, Kroenke's new stadium won't be ready till 2019. So this fall, the Rams will likely play in the Coliseum, the very arena which drove them out of Los Angeles so long ago. For Nightly Business Report, I'm Jane Wells.
Before we go tonight, here's another look at the sell-off on Wall Street. It was a difficult day. The Dow Jones Industrial Average plunging 364 points to 16,151. The Nasdaq dropped 159 points, nearly 3.5%, and the S&P 500 lost 48, trading below 1,900 for the first time since September. And just a week and a half into the new year, the blue chip Dow index is off 7%. The Nasdaq down more than 9%. S&P 500 also off 7%. And the transportation average got creamed
in bear
today.
market territory, even as oil and fuel prices go down. Not a good sign.
Not a good sign. But that does it for us tonight on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Have a great evening, everybody, and we will see you back here tomorrow night.